Hey traders, this is Blake Morrow with Traders Summit, and I have Mr. Deer from Deer Point Capital with us once again today. Good to see you, Deer.
Good to see you, Blake. How's everything going?
It's great. It's great. Much better that I'm here in the United States and not in China. As you probably know, China is in the headlines, and I'm so happy we get to talk, you and I specifically, regarding this. We were going to have another person joining us today. He's not feeling well, so we're gonna have another interview probably in a few weeks with the three of us. But hey, it's nice to have you here, just you and I again.
Yeah, thank you so much, and it's nice to be here as well. Always enjoy talking with you guys.
Well, I'm going to cut to the chase. I want to talk a little bit about China right now because China's obviously in the headlines, and it's funny. People in the trading community are like, "Yeah, Country Garden, Evergrande. Is this new news? I mean, how long has Evergrande been in trouble? It's been quite some time. So, should we really be worried as investors about what's happening in China? We all understand it's a slowdown, but is this really that alarming? Because it was alarming a year, 2 years ago as well.
No, for me, I don't think that it's really all that alarming. And this, as you mentioned, obviously, this has been something that's been going on for a while now. Um, Obviously, we are seeing, increased appetite for insurance in the form of credit default swaps. So if you look at something like the iTrax ex Japan, which is mostly weighted between Korea and China, more predominantly weighted towards the Chinese than Korea. Obviously, we've seen like an increase in where credit default swaps are trading. I think just as a function of the fact that people are looking for insurance, but I don't really think that this is anything new, right? We've known that Evergrande's been going through an issue, like you said, for about 2 years now. And yeah, I think that at least on that front, some of that might just be overblown.
So, that, and I'm glad you bring that up, just because, like I said, it's Evergrande's not like it's new headlines. I mean, the default numbers, the numbers that you're hearing in the news, it is alarming, but they've been in the news now, like, we were just saying, over the last couple of years. But here's the issue that I see, and I'd love to hear your take on this. Um, China was this year, in the year of 2023, we were looking for this huge reopening of China. Post lockdowns, China's economy was going to come roaring back, save the global economy. Next thing you know, we see rainbows and unicorns, and everything is good. But the problem that China has had during this reopening is their consumer has been not doing what China had been expecting or hoping, that you'd see more consumption from the consumer. And I think one of the reasons is we have this issue with the real estate market, with Evergrande and Country Garden and everything else. And if I'm a Chinese consumer and a lot of my investments are buying a second home or a third home, and that's where my investments have been going. Maybe China has, you see their consumers maybe going backwards and not being such a consumer driven society, but more of a saving, for a rainy day type of society. And maybe that's just compounding on the weakness that you're seeing in China. What are your thoughts about the consumer and where they currently stand?
Yeah, so I think that the consumer is relatively, let's not say relatively weak, but I just don't think that their appetite for consumption is there. And so, I think that that's where we start to get into this idea of like the liquidity trap, where, essentially China is trying to lower monetary policy. And there's actually an interesting thing on the rates that kind of that I'll touch on that came out yesterday as well. But what we're now seeing is that China's trying to ease monetary policy. But if we look at new yuan loans, the most recent number, we had new yuan come in at 300 and sorry, no, it came in at yeah, 345 billion yuan, and that was down from 3 trillion the month prior.
Wow.
So that's new yuan loan demand. And let me get the total social credit number as well, since I have that up as well. And
As
so
you're
this is
as you're
all,
pulling that up, I have to say that is a very alarming change.
yeah, it's a massive change. And so the prior month was 4.219 trillion. That's for total social financing. That's now at 528 billion. Um, So we've seen an alarming kind of fall off in aggregate credit demand. And so I think that most of that's indicative of what you get with a liquidity trap, which is, essentially for maybe people who don't know, where the central bank is trying to lower rates, but essentially at the same time, you're not getting the spurring of consumption. People are not going out and consuming or trying to get access to credit. Instead, they're building or hoarding savings and repaying debt. Um, and obviously that further kind of brings the economy into contraction. I think that that's really where the Chinese are. And I think that spills over into the housing market as well. If people aren't going and financing homes, then obviously you're going to have problems within the real estate market. And I think a lot of that's starting to kind of bleed through. And now China's kind of at this crossroads, which I think is they really have no idea what to do to keep kind of the growth engine spurred.
Yeah, well, and that brings up my next point that I wanted to bring up with you regarding China. Next question is, what can China do? I've heard a lot of analogies, in recent weeks that China is basically kind of like, throwing spaghetti against the wall. There's no bazooka coming at the market. They haven't come at the market with a big bazooka. They're just doing little bits and pieces here and there from a stimulus standpoint for their economy. What can China do to really right the ship here? Or is there anything that China can do at this point, in your view?
Yeah, I think really the only thing that China can do is start to focus on the fiscal side. And what's interesting now is, and this kind of gets into FX theory, but we got news from China yesterday saying that they might cut um, the reverse repo rate even further, as well as some other interest rates, because those interest rates were actually moving higher. And so for people who don't know, China's on a soft fixed exchange rate. It's not, fixed to a basket of currencies. But the thing is, when you don't have a free floating exchange rate, again, this is in theory, and people go out and they're shorting a lot of FX forwards, that actually drives up the domestic interest rate for China. And so essentially what we're now having is China's trying to struggle between getting the interest rate low and all of these people that are now shorting the yuan. And so it's actually started to very slightly, but it has pushed up the domestic interest rate. And so China's coming out and saying that they might have to cut rates. But with that being said, what can China really do? I don't think that they can any longer rely on the monetary side to do most of the heavy pulling, which they've tried to do, like we're saying, by controlling interest rates and keeping, the short end of the curve kind of pegged lower and lower and doing these kind of surprise cuts. I think really the only thing that they can do is focus on the fiscal side and try to build out fiscal expansion and actually build out productivity. But as we know, that hasn't really been the growth model for China. It's been more credit fueled. And so I think that again, they're at a crossroads where I don't think that the fiscal side is going to pick up the slack. And I think that China's just hoping that they can either, stimulate through monetary policy, or this is kind of getting into the BRICS discussion where we're trying to see China expand into these markets that are relatively untapped, where they can kind of generate an ROI on that front. And I think that that might be really the only model that China can really see for itself being sustainable.
Well, and that brings up our next point that I want to get into, because I know you follow the BRICS currencies, and we just came off a BRICS meeting, so we're going to discuss that. But before I get to it, I need to say this: if you all like what you're hearing from Deer Point Macro, make sure you give them a big thumbs up and subscribe to the channel down below so you don't miss any of our Traders Summit content and exclusive content that we have here. So, Deer, let's talk about the BRICS meeting. And let's talk about the demise of the U.S. dollar that's coming any day. That should be coming any day. That we've heard is coming any day. Right.
Yeah, I mean, this is the thing. I've been, and I'll probably put out a Substack on this, but a lot of people seem to kind of conflate this idea of settlement and invoicing. Two are very different in the sense that like you can settle trade in pretty much any currency. That's happened for a long period of time. But what's more important is kind of what we get into in the sense of what is called the invoicing of trade. And so essentially the easiest way to kind of explain invoicing is it's essentially where you have a dominant currency paradigm, i.e., pretty much the US dollar and the euro. And export prices are established essentially in that accepted currency vehicle. So they're think of them as essentially the denominator of all kind of global transactions.
Sure.
One of the most important aspects of that, though, is what we get with what is called exchange rate pass through. And this is essentially measures the extent to which changes in FX rates influence the price of goods and services within a country. And so essentially, maybe in more even simple terms, it gauges how fluctuations in a nation's currency value impact the prices of imported goods sold domestically. And so, if you were to look at something like BRICS, all of these nations have had extremely volatile moves in their currencies. I mean, even I think as of last month, we saw Russia saying essentially we don't want to accept rupees for the settlement of oil because, you were seeing such fluctuations at that time in the price of the rupee. So, I don't really think that they can overcome that issue. And so at the end of the day, they might settle in other currencies, but I don't see that as a big deal. I think that invoicing, that denominator is going to continue to be dollars. And so, as a function of that, dollars are going to continue to flow into the nation just as a fact of that's how all of these domestic exports are essentially being priced, the denominator of all these exports, right?
So yeah, and just to make it like so people can think about what you're and visualize what you're thinking. If China says, "All right, Brazil, we want to buy X amount of crude oil from you, or whatever agriculture or whatever commodity that you want," they're going to look at the price of crude oil or said some said commodity. They're going to look at it in dollar terms and say, well, crude oil is currently trading at 80.42 right now, $80.42. So I'm going to buy X amount of yuan that would purchase $80.42 in crude oil and give that to Brazil. But it's still quoted in dollars, right? Is that what you're saying here?
Yeah, essentially, that's one of the very important points is that that denominator of all of these transactions is going to continue to be in dollars because it's like I would argue really, and this will probably make the gold bugs happy, but over the last 100 years, there's really only two things that we know how to price stuff in: gold and dollars, right? Like you can see the price of oil in gold, and you can see kind of the price of oil in dollars. But really anything else, it's either too volatile or like unstable to really be able to use as kind of a measure of how you go about pricing goods and services. And so, as you said, yeah, that's going to be the thing. They're going to say, well, oil is trading at 82 US or $80 US, and we're going to go buy that amount of yuan and give that to Brazil. But again, kind of the denominator of all of those transactions is going to continue to be the US dollar.
So when you hear comments coming from the BRIC nations, and obviously two new countries have joined BRICS as well this as of this meeting, what do you make of these comments when they are bashing the dollar? Do you take anything away from that? Do you and you hear that they want to move away from the dollar? What is ultimately your takeaway after this BRICS meeting last week?
I don't think that they do. I mean, Russia, sure, I guess you could say so, but I think that that's more of a function of the fact that, I mean, they've been put in this situation due to the war. I don't think that they necessarily want to move away from the dollar or the euro. I just think that because of everything that happened, that's the only kind of substitute that they have right now. But for most of these nations, I don't see the reason to. I mean, we've seen India essentially come out and say that they have no intent of getting rid of the dollar. And that's one of the OGs. And, you know, even it was the what is it, the New Development Bank in Shanghai, which I think about 2 months ago said that they do not have enough dollar assets to cover their current dollar liabilities. And the new development bank is supposed to kind of be the, quote, central bank of the BRICS nations that's already saying that it actually has a shortage of dollars and needs more dollar funding to be able to essentially finance operations. So, you essentially have China's, new development bank that's saying, okay, we're in a problem where we are too short, like we don't have enough dollar collateral to cover our current dollar liabilities. And then you have India, another of the original ones, kind of coined by what's his name, Jim O'Neilly from Goldman Sachs, who coined the term BRICS, who's saying we don't have any incentive of moving away from the US dollar. And we did get news today as well that Saudi Arabia drained some of their FX reserves, but I started looking at their entire domestic dollar assets versus dollar liabilities, and they're in the hole about $3.5 trillion in terms of assets to liabilities. So, they have $3.5 trillion more liabilities than they do in current denominated assets. And now we're seeing debt outflows happen. So investors who are holding Saudi debt are now actually starting to liquidate that, because once you start to drain FX reserves, but you have all of these mounting liabilities and you don't have the collateral there to backstop them, if you're a domestic investor, you're going to get extremely worried, right? And
Right.
so
Why,
we're
like,
seeing
why would I want to hold that?
exactly. And so
Yeah.
it becomes this, like, people only really look at it at the face, like the 30,000-foot view, right? But like once you start to get into all this monetary plumbing and offshore funding and, you know, derivatives and FX contracts and forward rate agreements and all of these things that are settled between all of these nations and different counterparties, the whole situation becomes a lot more meddled, right?
Yeah.
And once you start to look at that, you're like, there's no way that they can move away from the dollar except essentially going into default, right?
All bark and all bite. It's what it sounds like to me.
Exactly. Exactly.
So, dear, I want to say thank you so much for spending time with us today. But before you go, I need to find out what's the best way to position yourself for what you think is going to come. And so we can start with, the dollar. I mean, do you sell yuan and buy dollars? Do you think the US dollar CNH continues to rally? How do you think other BRIC currencies are gonna operate here moving forward?
I mean, I definitely think that that is probably the best option. I mean, and not even just that. I mean, look at where we are with the yen today. I mean, the yen weakened massively as well, and so it seems like thus far the U.S. dollar relative to all kind of global currencies, and whether you're looking at the yuan, you're looking at the yen, you're looking at the euro, has really started to get footing again and started to gain ground. I think what the Dixie's at 145 and change today, or 105 or 104 and change, sorry, today. And so, I do think that that's really the play is kind of I do believe that the long dollar is going to continue to be the play, whether you're looking at China or other nations, just as a fact that, one, I think if you're looking at China, the differentials are just favoring the dollar, right? China's easing monetary policy. We now essentially, after Jackson Hole, have two more hikes baked in, 70% probability of September. And then after Jackson Hole, it priced in another 60% chance of a hike in this year. So two more hikes essentially being priced in. China's easing monetary policy, obviously from a differential standpoint, I think that that's going to favor the dollar. And then just maybe even if you're looking at EM exposure ex China has actually been the one that has outperformed. In the sense of flows, you're now getting outflows from emerging market ETFs that hold China into emerging market ETFs that are ex-China. And so I think that those are really kind of the ways that you protect yourself. But I definitely think overall, personally, I think that FX markets are way more attractive currently than what we're actually seeing in even equity markets. So kind of finding good FX positions will probably be the best bet.
And the interest rate expectations are going to be all over the map as we probably go into the end of this year and the beginning of next. I would guess, which is only going to create more volatility in the FX space. So, dear, I want to say it's always well, this is our second conversation we've had, and I know we're going to have another one here in the next couple of weeks. But I want to say it's been a pleasure having you here. What's the best way for traders to follow your work? I told you before, I told maybe my Twitter followers, you're probably one of the best, most underfollowed people out there right now. What's the best way of following your work?
Yeah, thank you so much, Blake. So obviously, as you mentioned, the Twitter is a great place, which is at Deer Point Macro, and then I do a Substack as well, where you're not confined to a character limit, and you can actually kind of get more on paper there, and that would just be Deer Point Macro at Substack, and so there I kind of cover all things. The last one was on China's FX and rate situation, so it's kind of a mixture of macroeconomics and some FX and rate stuff that I'm looking at or that I find interesting. So those are the two best places.
Well, thank you very much for spending your time with us here at the Traders Summit and with our community. So make sure you all give Deer a big thumbs up, and I'll catch you on the next conversation, probably after the U.S. Labor Day holiday and sometime into September, as we have a better picture of what's happening this fall. So thanks so much, Deer.
Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.